Ever see a headline about a company you know? Maybe one you buy stuff from or just, see in the news. And it's talking about their financial results.
Yeah, their stock is up, or maybe it's down, or they just announced something big.
Exactly. And you kind of get the gist, but you wonder what's really going on under the hood. What are the actual numbers and signals that the pros, the analysts, and big investors are looking at? Well, if you want to get past those headlines and really understand how a company's doing financially, you're definitely in the right place.
Yeah, this is where we try to give you that shortcut.
This deep dive is all about decoding that critical info, the stuff that shapes how the market sees a company.
And we've got some fantastic insights to help us do that, drawing from Maria Malone. She's the CFO at a pretty large UK media company. They do TV, publishing, the works.
Okay.
So her perspective gives us that real insider view, not just the textbook stuff, but what actually matters when you're managing the finances day to day.
Right, a practical take.
Exactly. It's about understanding what's genuinely important.
So our mission today, to kind of pull back the curtain on all this financial reporting stuff, we want to give you the tools to figure out a company's financial pulse.
We'll look at the key documents, when they come out, who's reading them, why they care.
And how it all connects to what happens in the real world, to the markets. This isn't about memorizing definitions, is it?
No, not at all. It's more about getting a feel for how it all fits together.
Okay, let's unpack this. All right, so anyone who's dipped a toe into company finance knows about the big three, right? The core financial
The
statement.
bedrock, yeah. Profit and loss, balance sheet, cash flow statement.
And Maria Malone, in her briefing, she really emphasizes they're not just separate reports. They tell a story together.
Yeah.
From your angle, why are these three just so fundamental? How do they actually work together?
That's such a key point. Because lots of people know of them, but Maria's focus is always on how they connect. Think of the balance sheet first. It's like a financial photo, a snapshot.
Right, on a specific day.
Exactly. What the company owns its assets and what it owes liabilities, plus the owner's slice, the equity. Assets equals liabilities plus equity. That's the equation.
Right.
Then you've got the profit and loss account, sometimes called the income statement. That shows how the equity part changed over a stretch of time.
Like a quarter or a year.
Precisely.
Uh-huh.
It shows the revenue coming in, the expenses going out, and the bottom line, the profit or loss. And that profit or loss, it flows back into the equity on the balance sheet. See the connection?
Okay, so the P&L explains the change in the balance sheet snapshot, sort of.
In simple terms, yes. But here's where Maria gets really focused. The cash flow statement. This is crucial.
Why is that?
Because a company can show a profit on its P&L, but still be running out of actual physical cash. Accounting rules allow you to recognize revenue before the cash is in the bank, for instance.
Right. So profit isn't always cash in hand.
Not necessarily.
Yeah.
Maria often says profit's important, obviously, but consistent operating cash flow. That's her, true North Star.
Operating cash flow, so the cash generated from the actual day-to-day business.
Exactly. Does the core business generate enough cash to keep the lights on, invest for the future, pay back debts? The cash flow statement tracks the real money moving in and out.
Yeah.
For a CFO, it's often the first place she'd spot a potential problem. It's the ultimate reality check.
That makes a lot of sense. The true North Star of cash, it really shows how you need all three views, doesn't it?
Absolutely.
The P&L for performance, the balance sheet for the overall financial position at a point in time, and cash flow for the lifeblood.
Yeah, like different camera angles on the same event, you need them all for the full picture. Different diagnostic tools giving you the complete health check, not just one reading.
Okay, so knowing what statements to look at is step one, but the timing is just as important for people watching these companies.
Oh, absolutely. The financial calendar.
Maria Malone's company finishes its financial year on March 31st, but that date can be different for other companies, right?
Yeah, December 31st is common too, but it varies. But the rhythm of reporting is usually quite predictable.
So walk us through that typical cycle for a UK company like hers. When do we get the news?
Okay, so soon after the financial year actually ends, let's say March 31st, the company will usually put out its preliminary results. People call them prelims.
Prelims. That sounds like a first look.
Pretty much. It's an early summary, the main numbers, the headlines. It gives the market a quick signal before all the detailed auditing is finished.
Got it. An early heads up.
Then, usually a few months later, comes the big one.
Yeah.
The full report and accounts.
The full beast.
That's the one. Everything's in there. Detailed financial statements, the auditor's official report confirming things, and importantly, a lot more commentary from the management. strategy, how they did, what they see coming.
So that's the really deep dive document.
Definitely. And for UK companies, there's another key point in the year. After the first 6 months, they publish interim results, or interims.
Halfway check-in.
Exactly. It's a mid-year update, lets everyone see how things are tracking against the plan, catch any big changes.
Now, here's something I found really interesting in the source material. The difference in how often companies report. You mentioned UK firms do these half-yearly interims,
Yes.
but US companies report every quarter, right? Every 3 months. That seems like a pretty big difference.
It is. It's a significant strategic difference, and it changes the game quite a bit.
How so? What does that mean in practice, say, for a CFO like Maria or for investors?
Well, think about it from the CFO's perspective first. Quarterly reporting, like in the US, means you're constantly under the microscope.
Right. More frequent updates, more pressure.
Definitely. Investors get a much more regular pulse check on how the company's doing. This can lead to faster market reactions, maybe more stock price volatility based on short-term hiccups. It puts a lot of pressure on management to hit those quarterly numbers.
I can see that. Constant performance anxiety.
Sort of, yeah. Whereas the UK's half-yearly model, plus the big annual report, maybe allows for a bit more breathing room, a slightly longer-term focus between formal updates.
Less focus on just the next 3 months.
Potentially. It could encourage companies to stick with bigger strategic goals without quite the same level of constant quarterly scrutiny. It's a trade-off.
So for you listening, it raises that question. How quickly do you need or want that information? Does more frequent mean better?
Not necessarily better, just different. Faster reactions versus perhaps a more considered longer-term view between reports. Both systems have pros and cons.
Fascinating stuff. Okay, so we've got these detailed reports coming out on a regular schedule. Now, who's actually reading them? Who cares this much?
The audience.
Maria Malone points to 3 main groups, doesn't she? Each looking at the numbers with a slightly different lens.
Precisely. Because each group has put money into the company in a different way, they have different priorities. First up, the shareholders.
The owners, basically.
Right. They provide the shareholders' money, the equity capital, that the company uses to operate and invest. In the UK, we say shareholders. In the US, they often say stockholders. Same thing.
And what are they looking for?
They want a return on their investment. That comes in 2 main ways. Dividends, which are basically a share of the profits paid out to them.
Based on how many shares you own.
Exactly. And the other way is capital appreciation, hoping the value of their shares goes up over time. Shares are traded on stock markets, like the London stock market.
So for them, Maria's team would be highlighting things like profit growth.
Yes, absolutely. Things like dividend growth, is it increasing, earnings per share, or EPS trends, are profits per share going up consistently. These signal a healthy, growing company and management's confidence.
Makes sense. Okay, who's group number 2?
The bondholders. These are people or institutions who've lent money to the company by buying its bonds.
So the company is borrowing from them.
Correct. The company borrows money in the form of bonds. It pays the bondholders a fixed percentage interest regularly, like maybe twice a year. And then at the end of the bond's term, it has to repay the principal, the original amount borrowed.
And these bonds are traded too.
Yes, on bond markets. So what do bondholders care about most?
Getting their interest payments on time and getting their original money back.
Exactly. They're less focused on massive profit growth and more on stability and safety. Can the company afford its interest payments? Is it likely to be able to repay the principal when it's due?
So what numbers would Maria's team focus on for them?
Key things would be ratios like the debt-to-equity ratio. How much debt does the company have compared to its equity? And the interest coverage ratio. How easily can the company cover its interest payments out of its profits? Low risk is the name of the game for bondholders.
Got it. Safety first. And the third group?
The third group is lenders, which usually means banks.
So regular bank loans.
Yep. The company borrows money from banks in the form of loans, and just like with bonds, they have to pay interest on those loans.
And their concerns are similar to bondholders about getting paid back.
Broadly, yes. They care a lot about the company's solvency, its ability to meet its financial obligations. But banks might dig into even more detail sometimes.
Like what?
Maybe specific conditions attached to the loan, called covenants, or the quality of assets the company might have pledged as security, collateral. They want to be very sure about repayment prospects.
So, as Maria Malone says, all these groups, shareholders, bondholders, lenders, they all take a keen interest in the accounts.
Absolutely. And what's really fascinating, as you said, is how each has skin in the game differently. Different risk, different reward potential.
Right. Shareholders take more risk, hoping for higher returns via dividends and share price growth. Bondholders and banks take less risk and accept lower, more predictable returns via interest.
Precisely. And a CFO's job involves communicating effectively with all of them, telling a financial story that addresses their quite different concerns and priorities. It's a balancing act.
It definitely sounds like it. So, bringing this all together now, these reports, these numbers, they aren't just filed away in a drawer. They hit the market and have immediate consequences, right?
Oh, absolutely. Very real, very immediate impact.
Especially on the company's share price. This isn't just theory, it's what happens every results day.
It's the daily reality for public companies. Maria Malone is very clear on this link. She says, good results cause prices to rise if the market believes the company is undervalued.
Okay, if the market thinks it's undervalued, so it's not automatic.
Not automatic, no. That's about expectations. But generally, good news lifts the price. Conversely, she says, poor results often cause a drop in share price as investors feel the company is overvalued.
So it's a reaction based on whether the results meet, beat, or miss what the market was expecting?
That's a huge part of it. Investors and analysts build forecasts, they have expectations. So results aren't just judged in isolation. They're compared against those forecasts, against the company's own past performance, against how competitors are doing.
Ah, the context matters.
Immensely. Strong results that beat expectations, that sends a powerful signal of confidence, potentially drawing in more buyers. But weak results, especially a miss against expectations, can really shake confidence, leading to people selling shares.
So the CFO isn't just reporting numbers, they're managing this whole perception game too.
Very much so. They understand how these numbers, once they're out there, translate almost instantly into market sentiment, perceived value, and ultimately the share price. It's a high-stakes communication exercise.
Oh, let's broaden this out. What does all this mean for us, the listeners? Even if we're not glued to stock tickers or managing bond funds, why should we care about these market reactions?
Well, if you connect it to the bigger picture, you start to see financial reporting isn't just this niche corporate thing. It's actually fundamental to the health of the economy.
How so?
Think about those share price movements. They directly impact a company's ability to raise more money if it needs to.
Ah, right. A higher share price makes it easier or cheaper to issue new shares to fund growth.
Exactly. For investment in new products, expansion, research and development, creating jobs. A company that's seen as financially healthy and well valued by the market can invest and grow. It becomes a more attractive employer, a more reliable partner in supply chains.
And the flip side.
A struggling company, with a falling share price reflecting poor results, might find it hard to raise capital. It might have to cut back, maybe lay people off. Those effects can ripple out through an industry, even impact local communities.
So understanding this helps make sense of bigger economic news and trends.
Definitely. It helps you interpret why some companies are thriving and others are struggling, why industries expand or contract. It shows how interconnected everything is, from the details in an annual report right through to jobs and economic stability. These reports tell a story that goes way beyond just the company itself.
Wow. Okay, what a journey today. We started with those big three financial statements: P&L, balance sheet, cash flow.
And crucially, how a CFO like Maria Malone actually uses them, really zeroing in on that operating cash flow.
Yeah, her true North Star. Then we mapped out the financial calendar, the prelims, the full report, the interims, and that key difference between UK half-yearly and US quarterly reporting.
Big difference in rhythm and pressure.
Then we identified the key readers: shareholders, bondholders, lenders, each group with their own specific focus, their own metrics they care about most.
Driven by their different types of investment and risk.
And finally, we connected it all back to the real world, how results hit the market, influencing share prices based on that whole dance between performance and expectations.
Yeah, it's not just numbers. It's about perception and value.
So the big takeaway here seems to be that getting a handle on these basics and maybe thinking about them from that insider angle really empowers you, doesn't it?
It really does. It helps you cut through the noise in business news, analyze it more critically, and just generally understand the economic currents around you better. Remember, these financial reports, they're not meant to be impossible to understand.
They're telling a story.
Exactly. A company's story, just told with numbers. And learning the language gives you a really powerful lens on the business world.
Absolutely. So maybe a final thought for everyone listening. The next time you see a headline about company earnings or an annual report gets mentioned, try thinking beyond just the headline number. Ask yourself, who's really digging into this? What specific trends are the shareholders watching versus the bondholders? Why do they care?
And what underlying story are these numbers really telling about where this company is headed, its plans, its challenges?
Exactly. It's more than just figures. It's a whole narrative about strategy, risk, and the future, just waiting there to be unpacked.